Yeah, just here to learn. So.
Great. Welcome.
The beautiful part is that we all started in exactly the same spot with owning nothing.
I own skyscrapers. I don't know what you're talking about.
Not the little miniature ones that are 2 inches tall, John, that you buy for $3 when you go visit places.
That's true. Sorry.
Hey, you're not supposed to admit that, John.
Justin.
Yeah, hey guys. I'm Justin Christian. I've known Greg and John for a while now, John even longer. I think Michael and I started joining the Bigger Pockets group around the same time a few years ago. Might even be more than that. I'm also a local agent, real estate agent. I don't have any rentals yet, but maybe in the next 9 months we'll be moving out of our live-in flip and moving on to the next one. But I like multifamily. I also work for a startup that works very closely with multifamilies for renovation, things like that. I won't go into it much, but yeah. So from that, I just am super interested in multifamily, and what I learned from here, I can basically at some point hopefully lead up the multifamily acquisitions for my company. So these guys are awesome.
Hey, Justin, I forgot I was supposed to let's schedule like maybe the Mary interview or something like that. We could talk.
Sounds good.
About that tech.
Yeah, sounds good.
Okay.
All right. I think that's the list, except for us. Do you want to introduce yourselves, or do you want me to introduce myself?
You can introduce us all.
All right.
As a team.
Well, I'm Angel. My company is Mastiff Home Buyers. I still consider myself new. I work full time, so haven't been able to dive in to investing as much as I would like. I do have a single family under a lease to own in Topeka. I'm from Topeka, so I know that area pretty well. Don't plan to buy any more in Topeka, though, if I can help it. And I am interested, I was interested in multifamily, but now I'm specifically really interested in trailer parks. We own a small trailer park in Adrian that we bought and have been working to renovate and bring it back to life. So that is my multifamily interest at this point. So if folks are maybe interested in that, let me know and we'll certainly can talk more.
I am interested in any way to make money.
Yeah.
So, I'm Greg Huebner. I've owned real estate since 2004, rental real estate since 2004. Actually, just last year was the first time I bought a single family house as a rental. I've scaled up, I scaled down, I scaled back up again. I've always been of the mindset and the belief that trying to maximize the dollar per square foot of an apartment, of a building, of a property, etc. And you know what is really that property's highest and best use. And so that's really where my focus is right now from a personal side. From a partnership side, I really enjoy working with other people, learning, teaching, mentoring, getting my butt kicked, et cetera, et cetera. All throughout. And so, Angel, you said you're learning, you feel like you're still new, but you've taken some action. I think Jordan, you said that you hadn't gotten anything yet. And so, I just commend you guys for just being here because number one, we can all learn from each other. We can bring all of our experiences from outside worlds into this thing and making sure that, we're, if something does transpire, that we're able to do it in a meaningful and thoughtful way. So John and I, we've done a couple transactions and it hasn't been smooth all the time by any sense of the imagination, but because we've had tough conversations, we've grown closer together, and we've learned a hell of a lot too. So I don't expect this to be all roses, but do speak up, because we're not always right. There's a lot of information out there. There's a lot of ways you can go about doing stuff, and it's that's what a team's all about. Jono.
Hey, yeah, no, yeah, I believe pretty much what everyone else is generally thinking about, scaling and growing with a core group in our circle. A lot of the, biggest investors, they might be companies now, but they started with a core group of people and partners, and that's how you grow. I'm not necessarily saying this whole team, it's impossible to become like a one company, but we'll definitely be able to benefit from each other, from knowledge and partnerships. And I think that's going to be huge, because we're all fairly young and we got a long way to go in our real estate investing careers. And, we do that through, I believe, partnering on bigger projects. I've started off with smaller stuff too, like everybody else. But then obviously you get to a time where you need to scale, because you don't have time. Maybe you don't like the day-to-day that it entails, and your time's worth more. Finding bigger deals, networking, raising capital, things like that, especially nowadays where you're not getting dirt cheap stuff like you were like a decade ago. So you kind of got to roll with how you got to roll with the economy and figure out new ways to, utilize the your margin and get more profits. And that's kind of why we've been concentrating on partnering up on bigger deals. So for some of you guys I don't know too, we've obviously just came together recently, Casey Multifamily Investing Group and Casey Capital Group, and we're trying to focus on underwriting on more of a commercial scale, and you'll be able to utilize that with smaller size deals, but at the same time, we're starting on a higher level, which I think is a little bit more beneficial than learning how to underwrite a single family home, which we should probably all know how to do anyway. So I think last week we talked about some deal criteria, about what do we talk about, location and comps and things like that. And I think we're going to run a little bit more with that now, because we don't have a current deal we're underwriting, but this will give everybody some knowledge on what people should be looking for, and how and it'll be a series, through this whole journey. But this gives us time to concentrate, to take an hour to deep dive in a little of this stuff. And this is, like Greg said, it's an open discussion, so we take a lot of time on each slide, which is good versus blowing through them.
We do as well.
Should we get into it?
Yeah, absolutely. No, I appreciate that, John. So last week I think we talked location, and kind of gave some very high level objective, subjective, maybe even criteria around that. Today we're going to go into a little bit more objectivity. I want to get through I think 4 topics here, and maybe even actually pull up a website of what we're talking about, and actually kind of maybe walk through it a little bit and kind of go from there. So these are more metric locations or metrics that we can use to identify an area, a city to go into. Not necessarily the specific neighborhood right now, but should we tackle a city? Again, this is just informational. We're not making an offer to do anything. So for metrics, there's basically 4 numbers to kind of kick everything off: a 20%, a 30%, a 40%, and then 500. We're not trying to play bullseye or anything like that, but does anybody have any quick guesses what these might even be to identify whether or not an area is good?
Is it anything with growth?
Population growth.
Population
Crime rate?
growth for which one?
Say
Oh.
30%.
What? Sorry, population growth is which one?
I'm saying 30. What are you saying, John?
30? Okay.
It could be 20 or 30.
Right.
I mean, dude, it could be 40 depending on
Oh,
the
it could be
time
500.
we're talking about.
Right. And then what do you got? Somebody said crime, I think.
Yeah, crime, 20 or below.
Okay. I think Jacob, I think your mic was muted. Yeah. What'd you say?
I was muted, yeah. I think it's the second one is population.
30 is population. Okay.
Well, some kind
Are
of
they-
transformation of population, yeah. Maybe not
you think-
exactly 30%.
You're making a presumption that everything is growing. So
Yeah.
I didn't say things were going to get better. So, but yeah, no, you guys are in the ballpark, definitely there. So, so 20%. So what you're looking for here at a 20% marker is you want to know that the area is growing, that more people are moving in. That's an early indicator. Now, you got to preface that with a lot of other data, which some of which we'll go through, some of it tonight, some of it we'll go through in the future, and some of it you just got to kind of have a gut feel for and things like that. One scenario is Orlando, Florida, where a lot of people fled from Puerto Rico and the islands and went there. So the population is growing, but is that a good determinant to make it a good investment? Now we kind of know we've heard that it is and everything like that, but if you're getting flooded with population, is there other metrics that you also need to cross check and everything when you go through to determine whether or not a city, again, like an MSA, metropolitan statistical area, which could include some of the adjoining suburbs and everything like that. Like Dallas-Fort Worth is an MSA, but I mean that's like a 200-mile diameter coverage from that perspective. All right, so there's a lot of good and bad areas within that MSA. So we're just talking about what big city do we want to go into? And Neil Bawa has some good rule of thumb for that. Is like if you go back to 2000, so now we're kind of 19, 20 years into that, has the population grown 20%? That's a good rule of thumb, he says, in terms of how to determine, do we continue digging into that city, or should we find another city that has population growth? For those of you that don't know, Neil Bawa, his background is as a data scientist, so he really loves data. He now owns some multifamily and things like that. He's featured on a number of podcasts. You can Google search him and find out a lot about him and listen to his podcast. And he's got data for how to determine whether an area is good and whether or not you should invest there, and also data on operational metrics, which we'll get into in some future talking point, I'm sure, around how do you manage the property manager aspects, and what are you looking for, the number of calls you have, inquiries for an apartment, funnel down to the number of qualified applicants, funnel down to the number of showings, funnel down to the number of applications received, and that's all a sliding scale based on the number of units available that you have, for example. So he's really popular in the space, and he's done a really good job of just trying to identify some metrics. So now, another thing you got to think about, though, from my perspective, so you got a growing population. So do you go to the heart of the city, or do you actually go to some of the surrounding suburbs and things like that? That's just a question I'm going to leave out there. I'm not sure if we'll tackle it next time or a couple months from now, or we'll kind of see where it comes out there. But just because Orlando is a good area doesn't mean that all of Orlando is a gold mine either. So.
And
yeah, go ahead.
And just to add something onto that too, took some notes from one of the Neil Bawa presentations. He's talking about cities between like 250,000 and 1 million should have growth around 20% or higher. Cities under the 250,000 mark should have 30% or higher. And cities over 1 million should have closer to 15% or higher. Obviously, they're bigger. And cities over 2 million should have 10% or higher as far as growth. And then, he was talking about some example cities like Ohio, he likes to pick on a lot. I think since 2000 to 2017. So, I mean, it's a pretty good span. It was up like 23 something percent. Charlotte, North Carolina, that was up like 58, 59%. So those are just a couple examples of, larger cities that have populations around, I guess here is, I figure it'd be a little bit more, but 850,000 looks like, but this is up to 2017. They were in that range. So that's kind of some metrics along that there.
Yeah, that's a good point, John. You got New York City, LA, things like that. You kind of don't want to see them growing at 20-25% every year. That's just a massive amount of people. And again, if you guys go back and search for some of those articles and listen to some of the podcasts that Neil does, he mentioned some of the Provo, Utahs, and the Pittsburghs, the Cincinnatis, things, those types of towns where there is a lot of activity going on. But yet the towns are relatively, smaller in the grand scheme of things, and they have the ability to grow for a decade, for a couple decades, which is really what you want to look at, doing all those things. So just from an example perspective, so one of the best sites that he really likes to use is a site called City Data. I'm going to need to erase my markings there. There we are. Cool. So mouse. All right. So citydata.com. That's a really great source right there. So we're kind of all knowing a little bit about Kansas City. So let's do Missouri. It's got bigger population there. So basically, what you're going to kind of see here is this population trend right here. This 2005 to 2010, in this case, in terms of how that population is growing. So, John, do you know exactly how to get in and see the wider range off the top of your head? I thought it showed it. Maybe you can just do a Google search for population of Kansas City, Missouri. There you go. Now here you go. Here you are from 1990 even. So it's like 442,000 to 491,000. So you got 78,000 population on 42 base. So you're just under 20%, about 16%, 17% growth since 2000. So Kansas City, Kansas kind of flatlined.
Hey, Greg, how far back in data do you look to get that metric? Do you look back 20 years, 50 years?
Yeah, Neil suggests about 20 years right now. I mean, you could definitely go back further. And I don't know if anyone, I guess financial markets is probably the easiest thing to talk about in relationships to charts and everything. But you want to be able to, the lower left to the upper right type of scenario. But at the same point in time, things only last for so long.
Yeah.
I mean, now it might last for 50 years. It might last for 50 days. So too. So, but so that's really where then some of the other metrics kind of get tailored in here. You want to see the population growing here, and even compared to other cities here too. Kansas City looks like it's flatlining and everything, and then all of a sudden, this was in so what year was this? In 2018? No, 2014. 2014 is 470, and now it's growing 20,000 in the last 3 years. Well, this only goes to 2018 too. So over 3 years, it grew 20,000 of that 70,000 population growth too. So is it starting to take off? And we kind of know it a little bit that yeah, it is. Now it's not gonna. I don't know if it'll go hockey stick or anything like that, but there's a lot of focus going into the Missouri side of Kansas City, and I invest there as well, and I see it, and experience it, and have benefited from it. So
yeah, like to add on to that, yeah, you're talking like cyclical growth, depending on you probably want to factor in economic blips, of course.
You're ruining my thunder.
Like you'll probably see, no, I'm thinking like in Las Vegas, and places maybe where they flood a lot, you'll probably see erratic dips. I'm kind of curious, because especially hospitality, Las Vegas has been getting the beat down.
Doesn't look bad.
Maybe places where they had a lot of upheaval, from the riots lately. You could see population change then. I mean, and taxes in general, just the growth of that. You should be hopefully seeing people leave California, and everyone's traveling to Texas and Arizona.
They can stay there.
But I mean, people who don't have, or normal people.
Well, here's a good one. Chicago. Chicago was about 2.9 million in 2000, 2.7 million 2018. Now, did the city of Chicago say, no, we don't want part of this land? You're no longer part of the city of Chicago? No. People are just leaving. Taxes in Illinois are high.
They're horrible.
You've got, San Francisco, 777,000. So they've grown 100,000 people in that time.
Hey,
but
Greg,
things are astronomically expensive too.
How much weight do you like to put on cities and states politically? Because obviously that's a huge deal. Rent control, taxes.
Yeah. So there's lists of like landlord-friendly states and things like that. Like I think Arkansas is the best one. But at the same point in time, you're not layering in growth opportunities too. So you just wanted me to talk on the topic, didn't you, John? I see you smiling back there. The political aspects, I try not to weigh into too much, but the economic growth engines is probably really more what I would do now. Texas, you don't have an income tax, but if you own property in Texas, you pay an astronomical amount compared to even Lawrence, Kansas, where I think we pay an astronomical amount compared to Kansas City, Missouri for property taxes. I have some properties that I pay like $200-300 a year for property taxes. That's a day rate in Dallas for a house, let alone an apartment building.
Well,
so,
and then since we don't have any,
so I try not to worry too much about the policies, or sorry, the political piece. But then I usually the economic component will fall out of the policy piece. So that's what I look for more. I don't look for a red or blue state or anything like that. I look at the economic drivers that the politicians would have implemented.
Well, I mean, maybe it's also down to more of a micro scale, because rental collections wise, vacancy and occupancy, they weren't affected as much, probably more in the Midwest. And we have proof of that with some complexes here versus, on the coast. So, and then there's also I don't know how much consideration of, there's obviously a huge consideration of states where they might not have income tax. So the property tax is huge, kind of like Texas. Isn't it like almost 3 times is what it is here? Not to say it can't be reflected in rent and other things, but.
Yeah, you just got to see if, I mean, the numbers will justify whether or not it's worth it, basically, and everything. But no, it's something you just definitely have to figure out and calculate. Cool. So that's a little bit on population growth. We're not diving too deep. We're trying to get some information out there. There's lots of sources you can dig into this. If you guys find a topic that you want to know more about, we can definitely kind of go into that topic and everything. This is kind of ours to construct and build how we desire. I mean, our goal is to, like we shared it last time, is to try to get enough information out there in the next, few weeks to go find some deals, kind of get them underwritten at a 5,000 foot view, and see if we can find some stuff to tackle together, basically, or a small portion of us or whatever. So 20% is population growth. What would be 30% then? Crime? 30% crime? John, you love crime.
Yeah, I love crime. What about income?
Income? We can do income. Perfect.
Yeah.
Hey,
Got lucky
you
there.
got it right.
Got lucky. So
I wonder if we're following similar notes.
we might be.
Hey, share the notes with me.
So
Nope.
So what's your well, but again, I mean, Neil Bala, he shares the same information. It's the same metrics. He doesn't adjust the metrics to fit what he likes to see. The data that he's found have driven him to discover these metrics. I'm a big believer that data tells the story. I mean, I've managed businesses and things like that before, and when you have to present the financial information for the quarter on how your team performed, when I was at a software company delivering and installing software, I mean, like, you had to understand what that data meant, for the metrics, for the the percentage of people that were billable and for how much, and the actual revenue that was generated, et cetera, et cetera. So I mean, data speaks, plain and simple. I mean, when you go in and look at a P&L of a property, like, that'll talk to you. You just have to discover what it means, but it's talking to you. And again, that's kind of what we're trying to display here and bring this information out here. So income. So you got 20% population growth. So again, going back to my Orlando example, if the population is growing, something else better be supporting that population, so that way they can live there. So income is how they, generally, people live by. So you want to see about a 30% growth in income, in like the median income for that area. Okay. And so that's going to help drive some inflationary measures and things like that. John, I don't want to go down that topic. So, but basically, again, just rational thinking. If you got people moving into an area, they got to have the ability to pay to move in the area. Michael had his 20 unit there in Topeka. If he's going to redo that and he's going to have people move in there, they've got to be able to support the rent that he's going to charge. They need to have an income. It's probably going to be a higher income than the 6 tenants that he kicked out, because of the work that he's doing and the value that he's adding to the property and to the area. And honestly, Michael, it might be interesting. I haven't thought about this, but it'd be interesting to know what that income level, and you did a lot with Section 8, so it might be a little bit different, but what the income level of the tenants you moved out to be to the tenants that you moved in, or from a Section 8 perspective, the difference in the amount that the tenants pay would be higher. So the housing authority will pay less of the monthly rent, the tenant will pay more, And in comparison, if somebody was paying $100 and now they're paying, now the new tenant has to pay $300 a month in rent, and the housing authority covers the difference. Well, that's a 200% increase with a $200 difference there that the tenant's paying. They probably have a higher income because the housing authority calculates all of that. The higher income allows them to charge a little bit more. I'm not sure if Topeka's growing or not, but there's obviously some income growth going on at that apartment building that Michael is turning around. So, any thoughts, John, on income? Well, before we switch over to actually viewing something.
Yeah. I think just something additional on that number is what we were talking about. Was it 30% or was it 40%? 30%. Okay.
Mm-hmm.
Yeah. So 30% growth. I think, was this over 15, 20-year span too, right?
Yeah, I mean, yeah, it's over a time. I would say at least 10 years, probably going back to a couple decades. I mean, you want to have some meaningful trend there.
Right.
Everyone can say that Dallas is getting overbuilt or something like that. Well, the policies that were put in place, 20, 25 years ago, those are going to be they're probably still going to be in place because it's going to be very hard to change that. However, 10, 15 years from now, you're going to start to see a new group of politicians coming in there, not to dive down that topic, and probably wanting to collect a little bit more revenue from these companies because they think the companies aren't going anywhere and they forgot that they moved from California or from some other state. So it's, but that's the cyclical nature of things that happen.
And then to add on to that 30%, it looks like he also likes to see a 2% growth for year after, in his example, like 17 years. So maybe you do 15 or a 20-year time span, a 2% annualized growth of those jobs. And it looks like it's 2% for cities under 1 million and 1.5% for cities over 1 million. And that's for 12 months of data, by the way. They're on.
Yeah, year-over-year growth. Yeah. So currently, keeping up with inflation, basically, is what he's trying to measure. Whether that's the Fed target of a couple percent or a CPI benchmark for inflation or something like that. But you can see right here, from the median household income perspective, you got about 38% growth in income overall, from about 37,000 up to 51,000 for Kansas City, Missouri. So, and Kansas City is just surprisingly, but a little bit lower than the whole of the state of Missouri, even. So, something to think about. What's driving that up? What's driving the rest of the state of Missouri up?
And you would be, and like you mentioned before, the caveat to this is you could always look into also the second tier markets, if they're actually, I guess the second tier markets you want to see a little bit higher growth too, right? Or I wonder if it'd be the same. Seems like it maybe be higher.
You want to
depending
be,
on population, I guess.
Yeah. It depends on if it's really a that's all it's going to give me. It depends on if, okay. That's lower. So here you go. Population of Kansas City, Missouri in 2019, 450,000. But yet they're saying it's 491,000. So you got to kind of be careful about where you get your data from. 505,000. Anyway, no, the suburbs, you got to kind of tell if it's a if it has growth drivers as well. And I guess probably the trying to think of Kansas City specifically. Lee Summit, is probably a good growth driver on the Missouri side. You know, I don't see a lot of necessarily businesses trying to come back into downtown Missouri. I know the Kansas side has had a lot of state credits and state incentives for businesses to move to Johnson County in the past. So, you know, you just gotta, you know, kind of dig up and some, I mean, all that's public information. They got to release it and everything. And so you just gotta, you know, you just gotta do some searching and Googling and figure that all out. That kind of answer your question, John?
Yeah. And there's probably some bias too, obviously, if it's your backyard and maybe, you know, a secret distribution center that's going in or something.
So it's 11% population growth in Kansas City, Missouri, on a 400, on a, you know, 500,000 people. So from John's additional metrics, so you know, Kansas City is not more than 2 million people, at least for this particular area. I'm not sure what the whole MSA is. That might be something to look at. Okay, so you're a little bit over 2 million people. So a 10% growth rate, you know, that might not be bad, actually. So if that ticks that box, now again, you're you know, at what point do you kind of, you know, narrow down your data size of what you want to get to? But if you're looking from an MSA perspective, you know, this would meet Neil's criteria of a 10% growth over for population over 2 million. So you have then you have the income growth right here, which was the 38% number right there. So that ticks that box. We're trying to find why Kansas City is not a good place to invest, but I'm not sure I'm going to get there. That way I can have more of it. But that's why we do this, so that we can.
Property taxes are going to skyrocket soon. We just don't.
I hope not. I hope not. But
Well,
and some
here's
areas there are the
something.
nicer areas. But
I think that sometimes in Kansas City, especially on the Missouri side, well, income is not keeping track with the rent growth. So the rents are growing, but the income isn't growing maybe as fast as the rents. And so people can't support themselves paying those rents. So I think there are a lot of factors that go into whether it's a good area to invest in or not.
Makes sense.
no, absolutely. Again, you know, just because these metrics are met doesn't mean that it's carte blanche. You know, go deploy
Right.
$10 million. I mean, I invest in Kansas City, Missouri. You know, I'm in and around 39th and Prospect. I'm in the Northeast. Looking at some places, and you know, a little bit south. You know, 77th Street. You know, kind of in around Bannister Road, a little bit north of the Sterner area by you know, a mile plus. Things like that. And what I've discovered is that area is almost how property by property. You know, I think there's still some rougher blocks, but I think it really depends on who lives in the property next door to yours that drive that area. I've got personal experience with that because somebody else moved in. Great block. I own 2 properties on the same block. Peaceful street. No half a dozen neighbors on it. Tenants going to look along great, and then somebody moved in, not a very good tenant, and they've been causing problems for everybody. So, but so no, it is. I mean, first of all, take everything with a grain of salt, and you know, you really need to back up whatever we find here with multiple data sources, and nothing beats boots on the ground. I mean, we were talking about that a little bit last time with location. You know, I mean, even if you have to partner with somebody and give them 5-10% just for being present and kind of giving a tick of approval that, yeah, this is a good area, this is a good property, et cetera, you know, that's worth it in my book, because you got eyes on the property, you got ears on it. Somebody other than the property manager, because you can again go listen to piles of podcasts about property managers gone awry. Probably make a whole podcast series on property managers gone awry. So,
Yes.
so 30%, so 40%. What's 40%?
Is that anything with owning versus renting?
Owning versus renting. So you want your rent price to be 40% less than the mortgage, or
No.
40% more?
I mean, I was thinking more in population, like 60% population owns a house, 40% rents.
Oh, gotcha. Okay. So home ownership.
Yeah.
Anybody else have any ideas? Because that's a good one, because that's the opposite of that is the home ownership percentage. That's ticking up. Anybody else? No one else? All
Doesn't
right.
John have the notes?
Did you say renters to you broke up for me? Did you say
Home ownership.
Yeah, basically home ownership. How many people own?
So this would be what percent of a population rent?
I
What
got
this
it.
one would
Yeah.
be.
Same thing.
That's important too. Yeah, for sure.
It is now if you're flipping homes. It's good. This is the home value. So you want home values. So what do you think you want to have to see in home values?
Increase.
You know, see home values increase. Okay. I like to see
Three
home
better
values
than two bad.
decrease.
Well,
So you basically want to see the home values over that, you know, give or take 20 years, have increased by about 40%. Okay. Now that's kind of like a median home value perspective, which is different. Median is different than the average. Okay. Median is the midpoint of all the numbers that were sold. So an average can be driven up by, or driven down by a lot of high value houses sold or a lot of really low value houses sold. I like to buy houses for $20,000, $25,000, and then I make them worth a hell of a lot more. So that's on a personal level. So I would actually drive the home values down in that area because of what I buy them for is not supporting it. But other people are selling properties and flipping properties in my area that are being rehabbed at a similar level, and so that's driving the price of homes up substantially. It's awesome.
And it looks like he also likes to see about 2.5% growth for years after.
Annually.
Yeah.
Yeah.
So
So basically, this is getting to an all ships rising. You know, I mean, you know, so this is natural appreciation. It's not forced appreciation. Forced appreciation is what you can do from rehabbing a property, a single family home, increasing the number of people that would like to buy it and driving the market up for that. Similarly, on a multifamily deal, making the operations more efficient, saving some expense money, also improving the quality of the place, driving higher rents, things like that. Those are all forced appreciation aspects. You create value out of thin air, basically, which is fantastic.
Yeah, and that's the one of the benefits Michael and I were talking about. Obviously, in the commercial space, anything residential, you're valued based on your comps, and comps could definitely they're not as much in your control, let's say, or
Right.
timeline. So, you know, we could push timeline even with forced appreciation, and that's also huge because the faster we can get that return and refi or sell, I mean, it's all about compounding your money, which is why, you know, everyone shouldn't really strangled idea of buy and hold when people are force appreciating by refining or selling and then compounding that money. They're making it work much faster versus waiting 30 years to sell the place and just collecting tiny bit of cash flow. So
coming back to Kansas City perspective, so the median house value for Kansas City, Missouri has increased 84% over the last 20 odd years. So how many of you guys would like to have bought on Troost Avenue in 2000 though? I wouldn't. I would like to have, but I wouldn't.
you just would have had to have some body armor or something. I don't know.
Yep.
Or a friend that lives in the same area.
Yep. So, but now Troost is all redone. Paseo's getting to be redone. Areas east of 71 are getting redone. Big new developments are going in. There's only so much land. There's a lot of empty land in Kansas City, Missouri. Houses that were raised.
When are you moving, Greg?
Oh, that's the beauty about real estate. You live where you want. You can invest. You invest where it makes sense.
Yeah.
So,
Michael, we'll get you a place there.
What's that? Meet me up there.
Yeah, we'll get you a place there. Greg has a rental for you.
I do.
Okay.
I do. I have one available right now. It's great. It's a cozy little spot.
Cozy.
We have a mobile home, Michael.
Oh, even better. On wheels.
Yeah.
Yeah.
Think about stealing it.
Cheap housing.
So yeah, I mean, it's real easy. You can extract this data. I don't know if you can actually export this data, John. It might be something to actually look into. Being able to get an API feed from city data, but you can look up the data, put it in a spreadsheet, update it once a year, see how the metrics change. You can do some fancy things just even within Excel for that. I'm sure there's data services you can pay for that even provide that type of information as well, and trends and all that type of stuff. So it's pretty easy to get this type of information. So to kind of summarize, 20, your 20% population growth leads to 30% income growth. Your 30% income growth leads to about 40% in property values. I mean, think about that. So you have people moving into an area. Businesses are probably starting up. There's a demand for more labor. In order to meet the labor demand, businesses got to charge more. The business got to pay more for their employees. The income that they receive. So their income goes up. They say, we've lived in this house for 5 years. I'm cramped. It's 2,500 square feet, but I'm cramped. But yet I can afford, an extra, $250 a month now in house payment, and that allows me to buy a 3,000 square foot house. And so that's really how these numbers kind of all tie together from a practical perspective. So again, you can go look at news articles. Business ABC is moving into town. Business XYZ is growing employees. You can probably get an RSS feed or something like that, if those even exist anymore, to get a daily update of all that information that's coming in there, and just kind of quickly synthesize it, and just is the news positive or negative from an economic perspective?
Yeah, that makes sense for sure.
So 500 bullseye.
500.
What do you want 500 to be? The average rent. No. Crime.
What you don't.
Crime. Again, crime. We talked about crime before.
I was going to say average credit score of your tenants.
So we'll send these slides out below, and I'll go over to city data right now. But basically, you're looking at an aggregate number. You want it to be below a certain number per 100,000 people. So the number of negative events that occur, you want that to be below this 500 threshold. what you'd also have is a declining nature of the crime occurring. Now, whether it's below or whether it starts above or below 500 is irrelevant. You still want to see a declining nature of the crime. And basically, when crime declines, so do the cap rates. And that's a good symbiotic relationship because the cap rate is the multiplier that gets applied, and the cap rate is also a percentage. So when you actually divide by the cap rate, and when you divide by a percentage below 100, values go up, and that's mathematics. You guys are getting like everything today. This is like, you guys can record this for your kids. This is school for the next week. You're golden.
They don't teach this stuff in school.
They don't. I wish they did.
That means, that means you'd have to not get that W-2 job.
Hey.
So crime. Got to scroll kind of further down here into this wonderful chart.
Oh, nice.
And you're going to see Kansas City, Missouri. Oh my gosh, I don't want to live here. So
500. That's not working for us.
So yeah, which I mean, that's not bad.
Yeah, but what kind of crime is it? Come on.
It's high. It's major
Murder.
crime. Yeah.
It's
No,
major.
it's major crime. Whatever, felonies, things like that. So,
Yeah, I don't.
sorry. This is what you want to look at right here. The crime index. Sorry, my fault. This crime index. This is what you want to look at. So, Kansas City is above 500. Does that automatically throw it out? Kansas City, Missouri.
Yes.
Okay.
No.
I'm moving to Kansas.
For our East and West Coast investors, yes.
Post that online.
I mean, I have bars on my windows.
I don't even have windows.
In Overland Park.
You just wall them off, right? You just wall them off.
I'm totally scared.
I live in a
Helicopter drops the food in.
Very scary.
Got a rope ladder you pull up, you can go come down the chimney.
Yeah, first time seeing the sun.
But and what do you see here though? I mean, you see a trend. You see a trend here. Okay. Now there's blips in the trend.
Yeah, that's
But-
interesting. I wonder what that was from. It looks like robberies or assaults. Apparently, yeah, I don't know.
There's nothing that really stands out at a dramatic level.
You're gonna see a lot of that.
But
bump up for
but look at but just go back and think about what was really happening. What was really spurring in 15, 16, and 17. Guys, that's 5 years ago. That's a long time. I mean, think about the areas that were being transformed in Kansas City, Missouri 5 years ago. Rightly or wrongly, again, throw the politics out of it. But look at what happened. And when movement occurs, sometimes bad stuff happens. But you also now have a downtick here, a pretty major downtick here, in terms of where we're at. So I mean, you had a low point of the 621, and you basically hit that, and again, kind of coming back to a financial charting perspective, you kind of hit that, you bounce back up, you got back down to the 620 again, you kind of bounce back up. That's called a double top in my book. The trend's going down.
Is this the stocks? Is this similar forecasting? This is the.
No, it's charts. It's double top in charts.
What I could tell from that, Greg, was that we have low arson, so we don't have to worry about fire. So that's cool.
Yep.
That's what you got from that, John?
You got here. There you go. Double top right there.
Going down, huh?
It's going down like gold
Well, as long as the
for a little while.
rent KC Tenants group doesn't push us out, maybe we'll be all right. Increase in thefts, we'll see.
So that's the story for this go around here. I got all this off of this website. The podcast notes were transcribed and everything like that, so we'll send that out. Again, you just Google Neil Bawa. That's like the third thing that popped up there. So, so that's it.
And then, yeah, I mean, those are it. Thanks, Greg, for going through that. I think a lot of people generally agree with those metrics. It's just a lot of us didn't know, how to put numbers on them. We obviously want increasing population growth, wages and jobs, low crime, growing cities. So that's definitely a big factor. There, and like you said, tier 2 stuff also has its benefits. Might not be as expensive. It won't be as crowded as far as investors. And there's also the caveat of some smaller towns having, we were talking about last week, military bases for to keep your tenant flow good there, or I don't know, small towns could have lower amount of multifamily apartment complexes, so you might be able to soak up all the tenant base there and not have so much competition like we might in popular places like Kansas City, where I think we had some around 6,000 units come on board for Class A stuff during the year. So that's also a factor. There's a lot of things to think about. So I think, what are we at? 7:12. Dang it.
I gotta get breakfast.
12
Lunch and
12
dinner.
minutes over. Anyone have anything else to chat about? I think next week we'll continue on doing some. We could talk about maybe locations a bit. We could look at the data that we scribbled on. You remember with James and myself and you were looking at as far as Orlando and Phoenix. We can run through that and maybe start to get into property specific criteria if you want to run through that next week. But anything anybody have right now they want to chat about or talk about? If not, it looks like, Greg, you answered every possible question they could have. So that's pretty sweet.
I'm just here to help.
We're processing and we want Greg to be able to eat so he can help us next week.
Sounds good. Well, cool.
Yeah.
Kept it
Let us
pretty
know if there's any other topics and things like that you guys want to talk about, and we'll keep down this path and go from there.
So we have the same time, same Zoom
same
link
place.
next week.
Yeah.
They're posted out there on the group, in other groups. We do have a monthly meeting tomorrow for our group, and we're going to be meeting at 6. I actually have a Google link out there, as it's mine. I set up that one, and John sets up the Zooms. And we're going to have folks talk about insurance for multifamily. So if you're interested in learning about insuring a multifamily property from the time that maybe you purchase it, even if it's empty, to putting tenants in it, and bring your questions. So that's going to be our topic tomorrow night.